Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. And we're going to talk a little bit about the idea of trading index options. We're going to follow along with some of the things that we have been doing. So if you are a regular returning guest to our discussion, thanks for coming back. Again, thanks to my good friend and fellow educator, 20-plus year veteran of the financial markets, Cameron May, who's out there helping out with the chat. He's there helping to answer any specific questions you might have. And of course, our thanks to our great production staff for helping to bring us this phenomenal webcast. Now, we're going to jump into this discussion here this morning quickly as we get into kind of a neutral day, and we'll talk about that in the context of indexes, and we'll see what's going on. But a couple of housekeeping items we need to take care of first of all. Remember that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation. It is not an endorsement of any particular security or strategy or pattern. Remember that Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, we're going to be talking about options today, and specifically index options. That's the name of the webcast. Remember that options are leveraged. They carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics, excuse me, and risks of just, of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions and spread trades, including the ones that we will be talking about today, need to be traded in a margin account. Now, we're going to be talking primarily about European-style index options. European-style indexes don't allow for exercise of those options until expiration, which removes early assignment risk. But some indexes are American-style. American-style short options can be assigned at any time up to and including expiration, regardless of whether they're in the money, at the money, or out of the money. So be aware of that fact. Now, we're going to be using the Thinkorswim desktop software platform today, as Cameron mentioned, and we've given some resources out there in the chat for learning about this particular platform. But we're going to be using the paper money version. The paper money version is a great sandbox for exploring ideas. It is not, however, a guarantee of future success out there in the real world. And it doesn't do some of the things that a live trading account would do, specifically one of those being the early assignment of short options. So as you move your practice from paper trading to live trading, make sure that you understand those differences. Remember that investing involves risk, including the loss of principal. Remember also that past performance of any security or strategy doesn't guarantee future results or success. Now, we're going to be talking about stop orders as well. And as we put these trades on, remember that a stop order does not guarantee an execution price, simply allows us to specify an activation price. And in the event of a stop limit order, there's the potential for that order area or that limit area to be gapped around, even with an index option. So be aware of that fact. We'll talk about those specific circumstances as we get to those in the discussion today. And our agenda, generally, we're going to talk about a review of index options, what's going on in the market right now. It's going to set us up with our market posture for the day. We'll look at some specific applications that we've been following for a little while, and then we'll create some examples here on the Thinkorswim desktop software platform. I'll give you an idea for those of you who are brand new, and thanks again for joining us. Some of the strategies that we will employ in this class, we'll talk a little bit about vertical spreads. We'll talk about iron condors. We talked about a calendar and a butterfly. We'll also talk generally about the idea of using index options as a means to hedge portfolios. So those are some of the things that we will discuss in this conversation today. But I'm going to switch over to the Thinkorswim desktop software platform right now. And as I do so, that's a good reminder for me to remind you to click on that subscribe button down at the bottom of the page if you have not done so already. If you've already clicked to subscribe, don't do it again. Don't click again, because that will unsubscribe you. And we don't like unsubscribing. We like new subscribing. So that's good. And it doesn't do us any good necessarily if you unsubscribe and then resubscribe, because it shows up as kind of a net zero. So just click on that subscribe button. It's a no cost to you, and it helps you out. It helps us out. Also, if you like this webcast, click on that like button as well. That pops this webcast recording up in the algorithm and may present that to somebody else who may have an opportunity to benefit from it as well. Also, as Cameron reminds you there, follow us on X at Ben Watson CS, at Cameron May CS, and all of the other education coaches in that same way. So Alexis asks a great question. I'll kind of lead off with this, right? Alexis asked the question, in what conditions would a stop limit be gapped around? And that might be a circumstance where overnight, and especially in an index, that can happen as well. It can happen in individual equities if there's, say, for instance, news that comes out in an after-hours time frame. Indexes are the reflection of kind of the collective pricing of whatever the components of the index are, right? So it sometimes becomes a little bit harder for indexes to gap on specific systemic news, but on overall news, indexes may move. So that oftentimes results from a change in the futures price overnight. So institutional investors may be trading the futures, and they move the prices, or you might have an individual component that makes up a large part of an index that moves after hours, and that would also potentially gap the index, right? And so if you were to see, let's say you set a 2-point limit, so your stop on an index was, let's say, for instance, if we had a stop order on a position here on the SPX, right? And we had set the stop to trigger at 60.94, and now the price of the index opens at 69 or 60.70, and your limit price, your stop limit was a limit of, say, for instance, 2 points or 5 points, then that order wouldn't get filled. That stop order wouldn't get filled. It would get activated, but it wouldn't fill because it would be outside the limit range of that limit order. And we've got some great webcasts that talk about stop orders and stop limit orders and order creation in that sense. And so that's a good way to kind of approach this. Now, we're not seeing a huge number of gaps in the SPX over the course of the last couple of weeks anyway, but neither are we seeing a lot of trending movement in the SPX. We talked a little bit about it yesterday. We talked a little bit about it last week. I'm going to just zoom in here on the SPX index. This is the S&P 500 index. And again, kind of banging into this resistance area right here at about the 61.26 mark. Now, currently sitting at 61.23. But this is the thing. Remember that support and resistance levels are often drawn as kind of big, wide areas. So I would argue that this whole area that the SPX has been trading in, really kind of from that 60 10 range up to 61.20 or so, 61.25, where we kind of are, that has been acting as a level of support and resistance. You know, the bottom edge of that range has been support. The top edge of that range has been resistance, and it's been a fairly narrow kind of top to bottom range. So a lack of volatility, I think, maybe is also an indication here, but we'll talk about what volatility is doing. But you notice what the relative strength index is doing. And so Cameron does a great job of this in his Getting Started with Technical Analysis and Advanced Charting Techniques webcast, where he talks about different technical indicators, RSI, Relative Strength Index, being one of them. But the main gist of this particular tool, this RSI tool, is comparing where candles are closing relative to where candles have been closing. So whether they've been closing closer to their highs or closing closer to their lows. So what this rising RSI suggests is that these candles have generally been banging their heads against their highs. You don't see a lot of upper shadows here. And so we're not seeing a lot of price discovery above that range, kind of in general. Now, you don't typically tend to see long upper or lower shadows on an index generally. because it is, again, that kind of collective movement. But you do sometimes, and you do sometimes when perhaps there's a little bit of weakness above. But what I think this perhaps suggests from a technical analysis perspective, the SPX running into this resistance, and likewise the NASDAQ as well, is that there's buying pressure pushing up. It's running into some fairly solid, or it seems fairly solid, selling pressure. But generally, overall, the driver here has been bullish, right? And so we're getting into kind of this bullish ascending triangle squeeze where we can see from the RSI rising that prices are starting to close against those highs. And at some point, theoretically, from a technical analysis perspective, that suggests that there is likely to be a breakout to the upside. When that buying pressure overcomes whatever selling resistance is there, then there's likely to be a move to the upside. And that can be news driven. It can be overall kind of collective assimilation of whatever selling pressure might exist. But this rising RSI isn't a guarantee of upward movement. But the rising RSI with a rising support level against a horizontal resistance level is oftentimes an indication of a potential break through that resistance at some point. Now, we could probably argue, when we clear these annotations for just a second, we'll redraw them. We could probably make the argument that if this is our resistance level and this is our support level on the SPX, and we're seeing that rising, that continually rising RSI, that this is long in the tooth, meaning it's deep into the apex of that ascending triangle. Generally, and Cameron talks about this as well, and Barb talks a little bit about this in her trading price patterns and breakouts and bounces webcast, is generally in an ascending triangle like this, we would see a breakout or look for a breakout somewhere between about 2/3 and 3/4 of the length down that length of the triangle towards the apex. We haven't seen a breakout there yet. We saw an attempted breakout and it didn't get anywhere. So there's still some resistance. Now, here's the thing, and this is kind of the counter argument to this squeeze that's going on, is that technical analysis also suggests that the deeper this gets into the apex of the triangle, the more likely it is to actually fail out of the triangle in the opposite direction, meaning we're more likely in this case, given the fact that it is long in the tooth in the pattern, to fail to the bottom of the triangle, right? So we'll got to think about, where is the context, though? The bottom of the triangle is probably down here, right around that 58 to 6,000 level, right? Yeah, and Jonathan asks a great question. Is it safer to buy after the breakout, or to anticipate the breakout by buying early? And I don't know if safe maybe is the appropriate word here in that particular case, because you can't necessarily talk about things in terms of a safe or unsafe perspective. You talk about it in terms of risk. Maybe the more prudent way to get into a trade is with clear evidence of movement, right? Either the breakout, right? So some traders might be losing a solid breakout or a breakout and a retest above a resistance level. Some traders might be a little bit more aggressive and take the bounce off of the support level and enter. A lot of different ways to approach that. And so, we talk about that also in that bounces and breakouts type of webcast. And CS says, ideal condition perhaps to put on an iron condor when there is neutral movement, potentially one direction or the other. But it also seems that this market is locked in a little bit of stasis in this particular case. So that's, I think, also part of that perspective. Now, the other thing to think about, let's take a look really quickly at the other indexes, right? So here's the NASDAQ, and we could probably make the argument that the NASDAQ, again, kind of banging its head right up against that resistance once again. We'll draw that line in here, right about there. And we've got that ascending triangle is kind of right at that 2/3 to 3/4 of the length. So this is not quite as long in the tooth, if you will, as what we're seeing on the SPX. And this is kind of at that point where maybe there is a potential breakout. Now, Jonathan also asks, do the wicks in the bottom indicate bullish movement? Longer wicks to the bottom would indicate bears pushing down and buyers stepping back in and pushing prices back up, right? So we're kind of seeing that scenario here, a little bit of push to the downside, so some selling, trying to nibble, and then the potential for the breakout. So here's what we have from a news perspective that might drive this, right? We have Fed minutes this week. We have other economic data this week that may drive this up and through. We've got that rising RSI, but it's not that yet there for that kind of directional upward move. And if this fails at this level and kind of fails out the bottom of this triangle, the bottom of this triangle really comes down to about that 28.53 range or so, where we've seen previous levels of support. So a lot further to go, a lot wider overall triangle in the NASDAQ, which tends to be a little bit more volatile because of its reliance on technology as kind of the core components of this index, tends to be a little bit more volatile, a little bit wider triangle there in terms of that potential movement. Now, the Russell 2000, which tends to be, as we've talked about before, more interest rate sensitive, seems to be kind of rolling down from what was maybe this, what Pat Mullally and I used to call a milquetoast ascending triangle. Milquetoast ascending triangle comes after a kind of a short or intermediate term pullback in a long-term uptrend, and it's not right up against the absolute high. It's up against this lower high. And so we're still seeing a little bit of a squeeze. I think we could make the argument that there's that diagonal trend line right there. But you look at what the RSI is doing here in this case of the Russell 2000, and I think we're starting to see a little bit more neutral movement here with that RSI, kind of in this particular case, going sideways. So that's kind of what's going on with these three major market indexes at the moment. The other thing I want to pop in here really quickly, and one index that we may look at today is our VIX, and this is the volatility index. So I'm going to zoom in over here on the right-hand side. We've seen what's gone on over the course of the last year. We see that big spike with the yen carry trade unwind. We see the big spike post the election, and this was kind of that surprise down move in the market. But let's kind of zoom in over here, and we can see in the last couple of days a little bit of a lift, although gap down and rally today in the VIX, up in the 16.5 handle at the moment, at least on the average. VIX sitting at about 15.56. And so that says potentially that there's a little bit of additional volatility bleeding in, but not quite as much as that we've seen before, right? We're not seeing this type of move up into the 20 handle. So still not a lot of volatility. That doesn't mean that the market's not volatile. And it doesn't mean that market participants aren't using protection. Now, I say that in the sense that, wow, using protection is probably a good idea sometimes. And many market participants do that, use some form of index option or futures contract to protect long stock positions. But they might also be doing other things. We talked a little bit about it in the futures class yesterday about using potentially gold as a protection. But yeah, you're right. CS is VIX falling generally means that volatility lower generally means that option premiums are lower as well, which benefits option buyers, because if VIX is low, it tends to rise, and if VIX is high, it tends to fall. It tends to be mean reverting. So we've got relatively low and rising implied volatility, which would benefit the buyers of options generally. And we talked about that as one of the reasons why we put on the trade that we put on yesterday, right? Okay. So let's go to the monitor tab here really quickly, and let's take a look at what we did last week in this particular case. We put on, utilities as a protection as well. We put on a calendar spread on the Russell 2000, on the RUT index, the one that we were just looking at, right? And that calendar spread, if we were to go to the Analyze tab, let's pop over here really quickly. And again, remember, anything that we look at simply for illustrative and educational purposes only. So let's put on RUT. And here's our calendar spread. And our calendar spread in this particular case, let me take that one off. Our calendar spread designed to take advantage of rising implied volatility generally, and volatility dispersion between the short leg, the one that we're short, which is the 21 February expiration, and the one that we're long, the 14 March. because we're going to see volatility impacting our long leg to a greater degree than it is, or rising implied volatility impacting our long leg to a greater degree than it's impacting our short leg. Because remember, sensitivity to implied volatility, or vega, gets smaller as we get closer to expiration, but theta gets higher as we get closer to expiration. So theta working for us, in this case, decaying away that premium in the short leg, while it is more slowly decaying away the volatility, or the extrinsic value, that time value, in our long leg. So benefiting from the passage of time, benefiting from a rise in implied volatility, generally calendar spread. So we talked about the idea of taking this trade off when it was making about 50% of its theoretical maximum gain. We're not quite there yet. In fact, it's really stayed just about exactly the same. If we go back to our monitor tab, we bought the calendar spread for $21.40. We have an order in here to take the trade off at $31. And it's really kind of sitting, for all intents and purposes, with the width of the bid-ask spread here, kind of sitting at about what we paid for it, maybe a little bit off of what we paid for it. So now the question is, in our short leg, the one that expires on the 21st of February, we've got 2 days left, right? So that has kind of moved in our favor, right? It's gone from $17.25 to $1.75. So we could potentially roll this short leg in our calendar spread, right? And rolling that short leg in our calendar spread might bring in a little bit more premium, reduce the cost that we paid for the trade to begin with, and allow us once again to kind of continue the duration of this trade. So let's look at that here really quickly. Let's go to the trade tab. And again, our idea behind this is rolling the short leg so that, and here's the cool thing about using index options is, with the fact that we have all of these different expirations, we got a lot of opportunities to potentially roll. So what I want to do is I want to roll this out another 7 days so that we can at least talk about this. Actually, let's roll it out to the 9 days to go until expiration. So we're kind of in the same place next Wednesday when we talk about this and seeing what that does. So we're going to roll this to the same strike. Let's open up our strike here. We're at the 2230 strike. This is the one that we are short. So we're going to roll one leg of this calendar spread. Now, rolling is not a magic wand. Rolling is simply closing one side and opening another side, either at the same strike or a different strike. But in the case of a calendar spread, we're going to keep it a calendar spread, so we're going to go to the same strike or different expiration. And rolling, like I said, is not a magic wand. It doesn't eliminate transaction costs. It simply facilitates a convenient way to move the order. So now here we are. We're going to roll this 21 Feb expiration 2230 put option, and we're going to buy that one back essentially, and then we're going to sell the 2230 in the 28 Feb expiration, which is going to net us theoretically about $6. Maybe $6.50 or so. That's going to reduce the cost of the trade overall, and it's going to put us in kind of a longer duration perspective. So this is something that you can do with a calendar spread because your long dated option is further out, gives you the opportunity to potentially roll, much like a diagonal spread does. A vertical spread provides limited opportunities to, you can't roll from one expiration to the other, one leg, without turning it out into something other than a vertical spread. You could roll the whole vertical out. But in this case, one of the potential moves is to roll the short leg of our calendar. So we're going to do this. I'm going to go back to the monitor tab and we'll just see how we'll accomplish this. I'm going to right click and I'm going to create a rolling order. So what we're going to do is we're going to choose the one, and this is oftentimes a question. Which one of these do I choose when I create that rolling order? And because we're buying back the short leg for less than we were paid for it to begin with, and we're selling another one, it's going to be a net credit. So we're going to be selling this calendar. Essentially, it's a calendar spread that we're creating to do this roll. But we're going to adjust this a little bit because it defaults to the next available expiration. We don't want to go just to the 24 expiration. That only pushes it out a few more days. But we're going to adjust this. We're going to adjust our short leg now out to a different expiration, which is we said the 28 Feb. So we're going to change that to the 28 Feb. And I said we were going to probably net about a $6 credit in this particular case. And that's what we're ultimately ending up with here if this fills theoretically, right? So we're going to go ahead and we're going to click on confirm and send. And all we're doing is we're buying back the 21 Feb 2230 put, and we're selling a 28 Feb expiration 2230 put. And we're doing that for a net credit of $6.10. So this is one of those scenarios. You got to pay attention to transaction costs because the roll doesn't eliminate those transaction costs. Here's the thing. If you're going to roll a trade like this, right? If you're going to roll a calendar spread, one leg of it, or if you're going to roll a diagonal spread, one thing that some traders may think about is rolling it for a credit or just not doing it, right? So I've got a phrase that I oftentimes use in teaching these and talking about these is roll it for a credit or just forget it. It's a good mnemonic device to remember what we're doing here. We're going to roll this for a credit because it doesn't make sense to add to the cost of the trade. In this particular case, maybe better to just close the trade down completely. But in this case, we're going to roll it for a $6 credit, theoretically. Make sure that it's going into our index options. Make sure that we're aware of any transaction costs. Pay attention to that. And we'll go ahead and accomplish that. And we'll see if that works for us. We might have to bump that order a little bit simply because the market is moving. So we're going to come back over here. There's our credit. We're going to right click, cancel and replace. I'm going to open up that lock a little bit. I'm okay getting $5.90 instead of $6.10. Click on confirm and send, read through the order once again. We'll make sure that that's going into our index options group and click on send, and we'll see if we can get that to fill by bumping it. And we got it for 605, so 6 and a nickel, and we did that roll. So now if we go back to our monitor tab and we pop in down here, we can see essentially what this trade now becomes, right? So we're now short the 9 days to go until expiration for $7.70 roughly is what we brought in against the cost. So we know that that was about another $6 trade of credit. So let's just use our calculator here really quickly to see what this calendar spread theoretically is worth now, right? So we paid originally for this calendar $21.35, and now what we're going to do is we're going to subtract from that a net of $6.05. So what we know is that essentially in accomplishing this roll, this calendar spread net cost to us was $15.30. We still have the order in place to close it at $31, so we're increasing our potential net maximum profit in the trade. But right now, the spread is trading. Let's see where that spread is trading if we were to take our mark price. So the spread is trading at $21.30. So we're now net profitable in this spread. And if we go back to the Analyze tab and we see where that is, and we take out the one that we are, let's see if we can take that one out. We'll just kind of take that back. So now we're kind of in that position where we've put ourselves into that net profitability. So, you know, something to think about in terms of putting that trade on. And part of that was accomplished. If we come back over here, let's go to our single grid and let's put on here the RUT. And again, the expectation is that this is kind of sitting right there where it is, right? And potentially benefiting if this goes down to that 22.30 range. That would be our theoretical maximum gain on the trade, but we're not quite there. Yeah, the exit order is still on that contract that I closed. You're right. So we're going to take that one off. I'm going to go back to our working orders. We're going to find that here. There it is right there. And we will cancel that order. So that's now gone. Thanks for catching that, Chris. I appreciate that. And we will create a new closing order for this vertical or for this this calendar spread by simply building an opposite order to what that is, and we can do that from the trade tab. So we know how to do that. We'll go ahead and do that and create that order to get out of that trade. But one more thing that I wanted to Yeah, absolutely. You can put in an exit order for the new roll for sure. See, yeah. But one other thing I wanted to get to here really quickly is this particular trade. And remember, we've been talking about this kind of on an ongoing basis. And the ongoing structure is using the SPX as long as it's still in an uptrend. And we'll go back to the chart and we'll go back to SPX. And as long as SPX is still in an uptrend, which consists of higher highs and higher lows, and that's certainly what we are making in this particular case, then we stay with that trend. I'm going to change my grid here really quickly to my index options grid, which I've shared before, but I'll go ahead and share it again out here in the chat. Remember, anytime we share anything in the chat, any of our grids or shared items, remember, those are not guaranteed as to time or accuracy, and they are simply illustrative and educational examples of things and tools that you can use. So there's that index grid. So the idea is we've been creating a short put vertical spread, bullish bias, at the right around the 15-cent delta. In other words, right around the 1 standard deviation range, 14 days out, and then we buy it back at 7 days out. And regardless of whether it's win or loss, we do that. Sell at 14, buy it at 7. Sell at 14, buy at 7. So here's where we are right now. We're at 7 days. So we're going to buy this back. And look, right now, if we were to buy this back, we can buy this spread back for a nickel. Now, you could do this as a roll. Again, roll's not a guarantee, but we're going to just simply close this out and buy it back for a nickel, which means that we made about $1 on this trade. Now, you're not always going to do that. That doesn't guarantee by any means that this is going to be a consistent generator of income, that you're going to be able to do it again and again and again because markets change. But the idea is that we're trading outside the range of where the market is. So we picked up about $1 in the trade. And we closed that down. We bought it back for 10 cents. I'm willing to sacrifice the 10 cents in this particular case, in this illustrative example that we've built for the sake of moving the trade out. So now we're going to go back to the trade tab and we're going to go to 14 days out. That's the 5th of March. That's 2 weeks from now. But we don't know what strike price yet. Now we could look at, I've got to go out a number of strikes here. I've got to probably go out 80 strikes to get to that 15-cent delta. And that 15-cent delta theoretically is right about the 59.65, 59.60 range. So let's go back to the chart. And we're going to come back over here to our chart. Now, we've got our probability of expiring cone. So we know that our expiration that's 14 days out is the 5th of March. So what I'm going to do is I'm going to come down here. You notice that I've got my cursor on the right-hand side vertically aligned with the 5th of March. Now I'm going to come down and I'm going to simply find the level on the 5th of March that intersects that probability of expiring cone. So the probability of expiring cone is simply a 1 standard deviation projection of where the price of the stock might be on a particular date. So 14 days out, the edge of that cone is right about 59.55, 59.60, somewhere in that range. So we go back to the trade tab and let's just confirm that. 59.55, that's the 14-cent delta. 59.60, kind of in that range, that's a 15-cent delta. So here's what we're going to do. We're going to sell the 59.60, and the methodology here is we're going to go 10 points wide. Reduces the cost. If we were to go wider, it's going to reduce the cost even more of the trade, reduce the impact on our premium is another way to say that. But the wider we go, the more absolute maximum potential loss we create. So I'm simply going to go in this particular case, in this example, 59.60 to 59.50. We're going to create this short put vertical spread. And we're not getting a lot, again, because remember that implied volatility has been kind of in that very, very flat range. But once again, we're going to look at taking this trade off in 7 days. Now, somebody asked me the question, and I'll just kind of illustrate this really fast here. But let's place this trade first while we're doing this, because this is moving around. So I'm going to go ahead and I'm going to click on confirm and send. I'm going to read through this. Again, this is the potential max loss is $900 against about a $90 potential gain. So from a reward to risk standpoint, it doesn't look great. But then you think about it in terms of probability, and it shifts that perspective a little bit. So I'm going to go ahead and we'll put this in our index options weekly strategy. And we're going to go ahead and we're going to send this order off, and we'll see if we can get 90 or better. We got it for 90 cents. That's okay. Last time we got it for $1.10. 90 cents is okay in this particular case, but we're at that, one standard deviation range where the stock is not likely to be. But here's what I want to project here, and I'm going to use my magic marker for this. So we're all familiar generally, if we've traded options before, with this perspective right here, right? This is expiration. This is that projection of price versus time, right? So that's my clock. That's price versus time. And so we're used to this kind of projection of time decay, right? So this is our theta projection, right? Theta, right? Yeah, exactly, Alan. That's why we're doing it on something like the SPX. I'm not worried about open interest and volume. It's because it's a highly traded product. Doesn't guarantee that I'm going to have narrow bid-ask spreads, and we might adjust that a little bit, but they were pretty close to one another. So here's the general perspective. This is an at the money time decay curve, right? This is an at the money time decay curve. And normally it's that projection that further out, so let's say this is 14 days, and this is 7 days, and we're buying, or we're creating the trade out here at 14 days, and we're buying it back here at 7 days. So if this were the at the money position, we're not getting a lot of benefit from time decay against our short vertical spread, because we're buying it here when time decay, or selling it when time decay is slow, and we're buying it back when time decay starts to speed up, which seems counterintuitive. But remember, we're not trading an at the money option, are we? We're trading a far out of the money option. So here's what happens with a far out of the money option. And without getting too deep into the math here, an out of the money, so I'll just label this OTM, out of the money, an out of the money vertical spread or an out of the money option does this instead of that logarithmic, typically convex curve that we're normally used to seeing. An out of the money option decays like this towards expiration. The closer it gets to expiration, to that bound, the closer it gets to that zero line cost-wise. But it slows way down. That rate of theta decay or time decay slows way down as we get close to expiration. In an out of the money option, this also works for a deep in the money option. So it becomes concave, that logarithmic curve. So what we're doing in creating that 14.7 time frame, if we're going 14 and we're buying back at 7, is here's what's happening. We're selling this vertical spread at a point when the rate of time decay, when that theta rate is high, and we're buying it back when that theta decay slows down, because it's a deep out of the money option. So this is the justification, or one of the reasons for using this 14.7 methodology. We're taking advantage of the convexity or that concaveness of this out of the money theta decay curve. So now you know one of the reasons why we're using the dates that we are and the times that we are, right? Because we get into this scenario taking advantage of greater time decay at the front end of selling the vertical spread as opposed to at the back end. So hopefully that helps. Now, Jerry asks the question, which is a phenomenal question. Why do we use, in this particular case, why do we use a 15 delta instead of a 20 delta? Well, we'd get more premium, but we're also closer within the range of potential movement. Because remember, we look at our chart, If we were to go to a 20 delta, we're going to be back here. So greater likelihood that we might get hit with a maximum theoretical loss. We don't want to take a maximum theoretical loss. We're still there. I mean, that freight train of that max theoretical loss is still there. That's a big freight train, $900. But we're putting ourselves in an area in this particular example where it's less likely to take that maximum theoretical loss, right? And Luis asks the question, yeah, this can apply to calls as well. Absolutely. It doesn't have to be a single option. It is the vertical spread, it is the calendar spread, it is the iron condor. It's just the nature of theta decay relative to in the money, out of the money. And the other thing to think about is the reason for that is because deep in the money, deep out of the money, there is less extrinsic or less time value as well. So this is kind of the approach and perspective on how we put this together, right? And so we come back over here to our monitor tab, and now here's our trade, right? We sold our original one or the one last week for $1.10. We bought it back for 10 cents. We sold this one for 90 cents. It's already starting to move in our direction. Again, as long as SPX stays in an upward trend, this is the approach, right? The methodology. Sell these vertical spreads at about the 15-cent delta, 14 days out, buy them back at 7 days out. We're kind of at that one standard deviation level. So we're cross-checking against the delta and the one standard deviation range. Okay, so that's kind of the approach here in that perspective. So thank you guys for letting me deep dive into that. This is something that I geek out about. I know that Cameron does as well. Cameron likes talking about the mathematics of this, and he has a great webcast. And I'll ask Cameron to pick this one up and drop the link in here, talking about why, and I think you did this before, why the option Greeks matter in terms of option pricing. So let's do that. Let's kind of recap this of what we've done. We took a look at what's going on overall in the market, generally neutral movement, right? And then we went to our RUT index, and we rolled our calendar, which was at the 2230 range. 2230 in this particular case happens to also be right about that one standard deviation line, right? And we rolled that out. We rolled the short leg from the one that expires in 2 days to the one that expires in 9 days so that we can do the same thing again if we potentially next week. The idea being that we want to see price kind of, our expectation of getting to maximum theoretical gain on the trade would be a slight downward move in this particular index. And we've kind of seen that, right? Maybe seeing a little bit of a bear flag bounce here. Not really a rise in implied volatility, but a rise in implied volatility would benefit us here in this particular case. So taking advantage of neutral movement. There's the webcast, understanding the vital role of the Greeks in option pricing. Thanks, Cam. I appreciate you doing that and grabbing that. Now, High Speed Low Drag says, hey, in theory, could you do this on a daily or a shorter term basis? Do that 14-7 or 2-1 or 2-0 roll? Yeah, absolutely. So there is that possibility as well. And again, attention must be paid, right? I mean, this is something that is not for sure a set it and forget it. This is something that you want to pay attention to, as is any option trade in terms of the potential risks associated with it. So that's what we've done today in this context. Is we've adjusted our SPX trade and we adjusted our Russell 2000 index options here as well. So we'll do this again. We'll revisit both of these come next week, next Wednesday. But keep these in mind. I'll talk a little bit about some of these contexts and some of these ideas in teaching market movers on Friday afternoon as we kind of wrap up the week. But I wanted to give you an additional resource before we go. Again, if you are new to this webcast or you are new to Schwab Coaching, check us out on schwab.com/coaching. Great place to start. You have the in-person events links. You have links to the calendar for our webcast calendar for each of the days and going forward. And then come back over here to the Trader Talks webcast page. Click on subscribe if you haven't done so already. And then you can search for calendar spread, for instance. And you can see all of those great webcasts that talk about that particular topic. And it's a great resource for you to continue your understanding of the strategy. So that's what we've done today. Again, my thanks to Cameron May for helping out today and answering questions. My thanks to our great production staff. And I will see you guys again very soon here on Schwab Coaching. Take care, everybody. Bye-bye.